Welcome, curious minds, to another deep dive. Today we're tackling a really interesting one, the Q2 2025 earnings report for Bank of America, or BAC, as you probably know it.
That's right.
You shared some, well, pretty rich source material with us, and our mission, like always, is to cut through the noise, find those essential insights, those surprising bits, and yeah, the aha moments that help you feel truly informed.
Indeed. And we'll be using our usual five-part framework. It helps integrate the company's own numbers with, real-time market insights. It's about getting beyond just the figures to the story they tell.
Right, the narrative behind the numbers. And before we dive in, just a quick but really crucial reminder, this deep dive is purely for informational purposes. It is absolutely not financial, investment, legal, or tax advice.
At least do your own research.
Always. And consult with a qualified financial professional before making any investment decisions. Also worth noting, this report was generated by an artificial intelligence model, pulling together data from the official earnings release and public market data.
Yeah, designed for accuracy, but we always say independent verification is recommended.
Okay, formalities out of the way. Let's unpack this Bank of America quarter. Now for slide 1, the at-a-glance scorecard. Looking at Bank of America's Q2 results, what's the immediate headline? The first thing that jumps out.
Well, the picture was kind of mixed, but I'd say ultimately positive if you're looking at it from an investor angle. The bank, it delivered stronger than expected profits, beating the EPS estimates.
Okay, beat on profit.
Yeah, but it fell just a little short on the revenue forecast.
Right. So what were those key numbers we need to keep in mind?
Okay, so diluted EPS, that came in at $0.89. That was better than the consensus estimate, which was $0.86.
Okay.
But total revenue, that was $26.5 billion, just slightly below the $26.77 billion analysts were expecting.
Okay, here's where it gets really interesting, I think. Despite missing on revenue, even slightly, the market's initial reaction was, well, favorable. What gives? What did investors focus on?
Yeah, that's the key question, isn't it? Investors appeared to prioritize the strength of the earnings beat. That plus the stability of the bank's credit quality. We'll talk more about that. And it's a pretty aggressive capital return program.
The buybacks and dividends?
Exactly. So in pre-market trading, BAC stock actually gained 1.2%. And initial analyst talk was, cautiously optimistic. They highlighted the solid underlying fundamentals.
Like core lending profits.
Right. Core lending profits, strong credit performance. They basically said those things outweigh the revenue shortfall and the sort of known cyclical weakness in investment banking right now.
Okay, makes sense. Let's look year over year then. What did those changes show?
So total revenue, $26.5 billion this quarter versus $25.4 billion a year ago. That's up 4.3%.
Okay, growth there.
Net income to common, $6.825 billion versus $6.582 billion. Up 3.7%.
Modest growth.
And then diluted EPS, $0.89 versus 83 cents. That's up 7.2%.
Right, that's 7.2%. That brings up an important point.
Yeah.
Can you quickly explain the difference between basic and diluted EPS and why diluted is the one we really focus on?
Sure. So basic EPS, it just uses the shares currently out there in circulation. Diluted EPS, though, it's more conservative. It calculates earnings per share as if all potential shares, like from convertible securities, were exercised.
So it's kind of a worst-case scenario for dilution.
Exactly. It gives a fuller picture, assuming maximum dilution. That's why it's the standard way to evaluate profitability.
Got it. So what does it mean then when we see diluted EPS growing at 7.2%, which is like nearly double the 3.7% growth rate of the net income itself? Where's that extra boost coming from?
Right. That's the aha moment here. That acceleration, it wasn't from some sudden surge in organic profit. It's a direct result of their capital management strategy, meaning the share buybacks. The EPS formula, it's simple. Net income divided by shares outstanding. Net income grew, yes, but the denominator, the number of shares, shrank quite a bit.
How much did it shrink?
Bank of America's common shares outstanding fell from 7.77 billion a year ago to 7.44 billion this quarter. That's a 4.25% reduction year over year.
Wow.
And that was driven by that aggressive share repurchase program.
Wow.
In Q2 alone, they returned $7.3 billion to shareholders. $5.3 billion of that was just buying back their own stock.
So fewer shares means the same profit gets divided fewer ways, boosting the per share number.
Precisely. It mechanically amplifies EPS. It's a deliberate strategy to boost shareholder returns beyond just the underlying business growth.
Okay, moving to slide 2, the engine of profitability. Let's peel back another layer.
Yeah.
What was the core driver, the real engine behind the bank's performance this quarter?
The main engine was definitely net interest income, NII. That's the bread and butter, right?
Yeah.
Profit from lending minus what they pay on deposits.
And how did that look?
It was robust, up 7% year over year to $14.7 billion. Management pointed to assets repricing in a good rate environment, continued growth in loans and deposits, and also strong contributions from their global markets trading side.
And you mentioned a trend here.
Yeah, this is the fourth quarter in a row of sequential NII growth. So it underscores a pretty powerful and consistent positive trend there.
What about the other side of the coin, the expenses?
Right, non-interest expense. That increased by 5% year over year, landing at $17.2 billion. The company said this was driven by strategic, quote, investments in people, brand, and technology.
Okay, investing for the future, presumably. But that expense growth was slightly faster than revenue growth, right?
It was, which resulted in an efficiency ratio of 64.6% for the quarter.
So for every dollar of revenue, almost 65 cents went to expenses. What does that signal to you for investors?
Well, it indicates negative operating leverage in the quarter, costs rising faster than income. So for investors, it's a trade-off, right? The bank's giving up some near-term margin expansion, hoping these investments will drive higher future growth.
So something to watch whether those investments pay off.
Absolutely. The success of these investments in generating enough future revenue is going to be critical to monitor.
Now, you mentioned banks measure profitability in specific ways. What about a key metric like ROTCE, return on average tangible common shareholders' equity? What's that telling us? BAC reported 13.4%.
Yeah, ROTCE is super important for banks. It measures profit relative to the tangible capital supporting the business, so it strips out things like goodwill. It asks that fundamental question, how much profit are they making for every dollar of real capital shareholders have invested?
And is 13.4% good?
Yeah, ROTCE in the low to mid-teens, like 13.4%, is generally seen as a sign of a high-quality, profitable banking franchise. It shows they're using their tangible equity pretty efficiently.
Okay, and what about the different profit streams within the bank? Was it balanced?
Definitely not balanced this quarter. There was a big divergence. While NII grew that strong 7%, non-interest income, so that's fees, wealth management, trading revenue, that only grew 1.0% year over year.
Wow, only 1%.
Yeah. So this disparity really shows that the bank's profitability this quarter was almost entirely dependent on its traditional lending and deposit-taking business. The fee-based parts, especially investment banking, which saw fees drop, acted as a drag on overall growth.
And just a quick note for those wondering, you might see fully taxable equivalent, or FTE revenue, mentioned in the release. What's that about quickly?
Right. FT is just a standard industry thing. It adjusts for the tax-free status of some income, like from municipal bonds. So you can compare all revenue-generating activities on an apples-to-apples basis. Makes comparisons easier.
Okay, on to slide 3. The engine room business segment performance. This is where we break down the bank into its main parts to see who's really pulling their weight. What's the big picture story here?
The big picture is really a story of diversification working as intended. You had impressive strength in the consumer and the markets-facing divisions, and that successfully balanced out a cyclical downturn in investment banking.
Let's break that down. Consumer banking.
Consumer banking. Revenue grew a solid 5.9% to $10.8 billion. But net income surged, up 15.4% to $3.0 billion. This was really the bedrock. Great cost control, strong operating leverage, driven by higher NII from good deposit and loan growth, and stable credit costs.
Okay, strong consumer. What about wealth management? Joan?
Global wealth and investment management, yeah. Revenue up 5.4% to $5.9 billion, but net income actually dipped slightly, down 2.3% to $1.0 billion. Expenses grew faster there, about 9%, due to what they called revenue-related incentives and investments.
Okay, then global banking.
Global banking was the clear laggard this quarter. Revenue fell 6.0% to $5.7 billion, and net income plummeted almost 19.7% down to $1.7 billion.
Oh, and finally global markets?
Global markets was the star performer. Revenue jumped 9.9% to $6.0 billion, and net income grew 8.5% to $1.5 billion. Really powerful result.
What drove that?
Driven by a 14% increase in sales and trading revenue. Both FICC, fixed income, currencies, and commodities and equities trading posted double-digit gains. And get this, it was the 13th consecutive quarter of year-over-year growth for their sales and trading business.
13 quarters straight. That's impressive consistency.
It really is. And what's fascinating stepping back is how the universal bank model just proved its worth. That big $417 million drop in global banking's net income. It was almost entirely offset by the $378 million increase in consumer banking's profit.
Man, almost a wash.
Almost. And then the extra $118 million profit gain from global markets, that basically provided all of the corporation's overall profit growth for the whole quarter.
That is a textbook example of diversification, isn't it?
Exactly. When one cyclical part, like investment banking, falters, the stability of that huge consumer business and the opportunistic nature of the trading business can step in. It leads to stable, even growing overall profits, even when parts of the market are tough.
Okay, let's turn to slide 4. Financial strength and shareholder rewards. Beyond just the quarterly profit numbers, what do long-term investors really zero in on?
2 key pillars, really. First, the resilience of the bank's balance sheet, how strong is it? And second, its commitment to returning capital to shareholders. And on both of those, Bank of America showed significant strength this quarter.
So, starting with the balance sheet, how robust is their capital position?
It looks very robust. Their common equity tier 1 ratio, the CET1 ratio under the standardized approach, was 11.5% at quarter end.
And what does that 11.5% mean practically?
Well, CET1 is a critical measure of a bank's ability to absorb unexpected losses. That 11.5% level is, as they say, well above the regulatory minimum. It gives them a substantial safety buffer.
Can you just quickly demystify CET1 for us?
Yeah.
Why is it the number people watch?
Sure. CET1, Common Equity Tier 1, it's basically the most important gauge of a bank's financial muscle. It compares the bank's highest quality capital, mostly common stock, and retained earnings against its risk-weighted assets. Regulators set minimums to make sure banks can handle severe economic stress. So higher ratio means more resilience.
Got it. Higher's better buffer. What about credit quality? That's always crucial for a bank.
Right, a cornerstone. And credit quality remained excellent. They set aside $1.6 billion as a provision for potential future credit losses. That was up slightly from last year, reflecting loan growth and just a prudent economic outlook.
So planning ahead. But what about actual losses right now?
That's the key part. Net charge-offs, the actual loans they had to write off as uncollectible, held steady at $1.5 billion. And that's for the 6th consecutive quarter. Pretty stable.
6th quarter steady. And the CFO gave some color on this.
Yeah, Alistair Borthwick, the CFO, provided some important context. He said, quote, asset quality remains strong. Consumer delinquencies have been stabilizing, while card net charge-offs improved year over year and commercial non-performing loans declined sequentially.
Stabilizing delinquencies.
Oh.
That sounds encouraging given some broader worries.
It really does. And that strong foundation, that excellent credit quality, sounds like it allowed them to be pretty aggressive with shareholder rewards. What did that look like?
It definitely seemed to enable it. They returned a total of $7.3 billion to shareholders just in Q2. That broke down into $2.3 billion in common stock dividends and that huge $5.3 billion in share repurchases we talked about.
Wow, $7.3 billion in one quarter.
Yeah. And on top of that, they announced plans for an 8% increase to their quarterly dividend. That's a clear signal of management's confidence in future earnings.
Definitely a vote of confidence.
You know, this data on consumer health from BOFAS, stable charge-offs, stabilizing delinquencies, even seeing card spending up 4%. It really seemed to push back against some of those broader market fears about the consumer weakening, doesn't it?
It absolutely does. Amid all the talk about inflation and headwinds, the bank's own specific metrics paint a picture of resilience, at least within their massive customer base. It suggests the American consumer, for them, is still on pretty solid footing.
And that feeds back into everything else.
Exactly. That underlying credit strength is the foundation. It lets them generate consistent profits, which then lets them return significant capital via dividends and, importantly, those big buybacks. The buybacks reduce the share count, amplify the EPS growth. It creates this virtuous cycle. Strong operations and credit quality fuel buybacks, which boost EPS, reinforcing shareholder value. It's a powerful loop when it works like this.
All right, finally, slide 5. The road ahead management's outlook and key takeaways. What did management actually say about the future? What's the vibe?
The management commentary really just reinforced the quarter story. Stability, disciplined execution. They sounded pretty confident, especially about their core earnings engine, the NII.
What did the CEO say?
Brian Moynihan, the CEO, he summarized it pretty well. We delivered another solid quarter, with earnings per share up 7% from last year. Net interest income grew for the 4th straight quarter. Consumers remained resilient. We saw good momentum in our markets businesses. Pretty straightforward summary of the strengths.
And the CFO?
Alistair Borthwick echoed that stability theme. Asset quality remains strong. We delivered strong loan and deposit growth and maintained our disciplined pricing. Focus on execution and stability.
Okay, so positive commentary. What about actual forward guidance? Anything concrete?
Yes, they reaffirmed their guidance for net interest income. They expect NII to grow into a range of $15.5 billion to $15.7 billion by the fourth quarter of 2025.
So they expect that main engine to keep performing well through year-end.
That's the message. It's a confident projection suggesting they expect that primary driver of recent profitability to continue its strong performance.
Okay, let's try and distill all of this down. What are the key takeaways for you, for our listeners, from this Bank of America deep dive?
All right, four main things, I think. First, mixed headlines hid underlying strength. Yeah, the revenue miss got attention, but that 7% II growth and the 7.2% EPS jump show robust core performance. That led to the solid profit beat.
Okay, look past the headline revenue miss.
Second, the universal bank model proved its worth. This was a great example. Strong consumer banking profits and great trading results in global markets really did offset that cyclical slump in global banking's profit. Diversification worked.
The different parts balanced each other out.
Third, aggressive capital returns are amplifying shareholder value. Remember that EPS grew almost twice as fast as net income. That plus 7.2% EPS growth versus plus 3.7% net income growth. That's the direct result of that massive $5.3 billion share buyback. It's mechanically boosting per share returns.
Buybacks driving a big part of the EPS growth story.
And fourth, credit quality remains a pillar of strength. This is key. Contrary to some market fears, BofA's credit metrics look excellent. Management talking about stabilizing consumer delinquencies gives you a data-backed view of a resilient consumer. And that underpins everything, their profits, their ability to return capital.
Solid credit is the foundation.
Exactly.
So the overall narrative for Bank of America's Q2 seems to be one of, well, disciplined execution in what's still a complex environment. They navigated the investment banking slowdown by leaning on their strong consumer and trading arms.
Right.
The profit beat wasn't about explosive growth, but more like a well-oiled machine working. Solid NII from resilient customers, disciplined spending, and that shareholder-focused capital strategy amplifying the results.
Well put. And management reaffirming that NII outlook suggests they plan to stick to that formula stability plus strategic capital deployment. That seems to be the main plot line for investors to follow. And, by analyzing earnings like this with a consistent framework, you really can get beyond just the headlines. You identify the real drivers, assess the financial health, understand the outlook. It's a repeatable process, helps you build a much deeper understanding over time.
And that is exactly what the deep dive is all about. So let's leave you with a final provocative thought to chew on. How might similar structured analyses of other major banks reveal different, or maybe reinforcing, patterns about the wider economy? And what does this specific performance of the universal banking model really tell us about navigating different market cycles going forward? And one last time, just a reminder, this deep dive was for informational purposes only. It does not constitute financial, investment, legal, or tax advice. Please do your own research. This report was generated by an artificial intelligence model. Like and subscribe to stockanalytics.ai. YouTube channel, members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.